Hi there, Etoro. It is Monday, the 29th of August, and that means it's time to take a look at what moved the markets last week. I probably don't need to tell everyone watching this video, but last week was a sea of red. In the SP500, try and count the number of green blocks that you can see, each one representing a company. I think maybe there are 4 or 5 companies that were green at the end of Friday. It's a very similar picture if we look at a heat map of the NSDQ100. And if you look at the percentage declines here, you can see that some of them are quite chunky, but there tends to be a concentration in the semiconductors. And that's because semiconductor companies tend to be highly cyclical. They're very correlated with the economic cycle. So when the economy is weak, semiconductor sales tend to be weak, and vice versa. So the market is sending us a signal here based on what we heard on Friday. Now jumping to the chart, you can see a big fat red candle for the NASDAQ 100 on the top left, big fat red candle for the SP500 on the top right. And you can quite easily see that each of those indices has given back all of the gains that they made in August and then some. If we look in the bottom left, we can see the CSI 300. So the chart, the price action there, a little bit less dramatic. We can see on Friday that there was a bit of a drop off and that the markets opened down today, although they have jumped nearly 0.5% through the session today. Now, if I were to summarize the price action through some of July and August, I would say that the market had been expecting something of a more dovish Fed and maybe other central banks through the rest of this year, a slowdown in rate hikes, and maybe a drop-off in rates at some point next year. So rate hikes peaking next year and then dropping off slowly through the year as inflation subsided. However, through part of August, the market has reversed this decision and has said, actually, we think that rates might stay higher for longer. And then on confirmation of that last Friday, or seeming confirmation of that last Friday, we saw the markets drop dramatically. Zooming into the 10-year Treasury yield. So I'm looking at the 15-minute chart here, and the reason that I wanted to do that is just to show you the volatility around Powell's speech last week. So Powell started talking around 3 p.m. on Friday, and that's this red candle, but preceding that there was a lot of volatility. And then during that speech, yields jumped quite dramatically and then fell off quite sharply. And actually you'll see something similar if we drilled into the 15-minute chart of equities or indices. We would see that initially there was a big jump and then an enormous drop off through the session as it went on. What's also quite interesting is that the bond market tends to be thought of as smarter money than the stock market, and you can see that although treasuries dumped and then jumped, or treasury yields, we can see that the price level here isn't dramatically off what it was in the days preceding the meeting on Friday. So it does look as though the bond market seemed to have correctly anticipated the direction that the Fed would take on Friday, and so the yields are more or less where they were leading up to that meeting. Now, with everything dumping on Friday, we've also seen a jump in the US dollar index. It touched 109 for a while, although it has retreated a little bit. And as I explained previously, a stronger dollar does help a very small parts of the population in the US, those companies that are importers of things into the US. But overall, a stronger dollar tends to be bad for the US as a whole, but also for economies around the world. You can imagine that if you were, for example, a South American country holding a large amount of US denominated debt, so let's say hundreds of millions, maybe billions, and the price jumps from what it was 2 weeks ago around 105 to what it was recently 109, so a 3 or 4% increase in your debt repayment obligations on hundreds of millions or billions of dollars. That's a lot of extra money that you need to find to pay the servicing cost of that debt. All right, so what caused this price action on Friday? I think probably most people know. So there were some interesting pieces of data out of the macroeconomic data out of the world last week, but just about all focus was on Powell's speech on Friday. Leading up to that, we did have the interesting piece of data, the core PCE price index data, that month on month came in lower than was forecast, quite a lot lower. And this is the Fed's preferred measure of inflation, for those of you that remember. And also the day before that, quarter-on-quarter GDP for the US was set to show a decline, but came in softer than was anticipated. So instead of a decline of minus 0.8%, came in at minus 0.6%. So these two pieces of data are a little bit more optimistic than what we heard from the Fed on Friday, but let's focus on that for now. All right, so this is a transcript of the speech given by Chair Jerome H. Powell, and it's not very long. I mean, you can read the whole thing if you Google for it. It's quite easy to find. I've highlighted a few of the key statements that I found quite interesting. So right out of the gates, he said, "Today, my remarks will be shorter, my focus narrower, and my message more direct." Now, no good message is going to be preceded with that, so you knew something bad was coming. And with this particular speech, it becomes evident that Powell is trying to shake the markets a little bit. He's trying to get them to wake up. He's trying to get all of us to stop trying to anticipate his pivot and to focus on the fact that he's trying to bring inflation down, and he won't pivot until there's very strong evidence of that. So you can see that reducing inflation is likely to require a sustained period of below trend growth. So immediately he's saying, we're going to have some economic trouble because I really want to bring inflation down. The next highlighted paragraph says, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. And you'll see that this particular statement has been reprinted in the media around the world through the weekend and today. The problem that the Fed is trying to fix right now is that with the rally that we've seen in equities and the movements that we've seen in the bond markets, is that investors are more optimistic than they probably should be. And there is the potential for the tail to wag the dog here, and he's trying to undo some of that. So if markets are rallying and looks like everything is good, then people will start behaving in particular ways, which might keep inflation high or even take it higher than it was for the past few months. However, if Powell is saying, stop what you're doing, I'm going to keep these rates high, inflation must come down materially, then that's going to change the behavior of the market participants to be more in line with the way that the Fed wants us to behave. Now, I'm not going to read through the entire transcript. It doesn't take very long, as I said before, but he does point out a few lessons that he's learned by looking back historically through periods of high inflation. And one, I think, is quite interesting because I think this is the one that he's actually focusing on right now. He says of periods of high inflation, historic high inflation, the more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and pricing decisions. As former chair Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself. So part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. An example to consider here is, let's say you run a small business and your employees expect inflation to stay high. So they're coming to you and they're saying, I need my wages to go up because I'm becoming poorer. I can't afford electricity and food, etc. So you're putting these wages up because they're anticipating inflation to stay high. Because you anticipate inflation to stay high and you think your supplier is going to keep high prices, you put your prices up. This in turn gets other companies to put their prices up and consumers to anticipate that these prices are going to be high. And so the cycle begins of inflation expectations feeding inflation, making it sticky. And so with strong statements, the Fed is saying, stop. Inflation is going to come down because I'm going to make sure it comes down. I'm going to do everything I can to make sure it comes down. And so the hope here is that they're breaking this cycle. They're breaking this mindset that inflation is going to stay high, even if it comes at the cost of economic growth, even if there is some pain to businesses and households, as he stated earlier in his speech. The market reaction following the speech was, we believe you. We think you're going to keep these rates high. We think that you're going to hit growth enormously, and so this drove a massive risk-off attitude. We also heard from a number of the other chiefs, heads within the Fed, and so one of them, Meister, made the statement, a very strong statement, that we're going to have to bring interest rates up to maybe a little over 4% early next year and keep them there. And by keep them there, she meant keep them there for the whole of 2023. And this statement in particular, I think, rarely scares the market. This is showing that to break the back of inflation doesn't mean just raising interest rates, waiting for inflation to kill over and then bring them down quite rapidly once again, but that they are potentially just going to hold them there at that level. Now, my research suggests that this level of interest rates is unlikely to be held by the Fed because the interest rate is the base that determines the debt servicing amounts, obligations that people have to pay on whatever debt they've taken out. The Fed holds an enormous amount of debt. Households hold an enormous amount of debt. Companies hold an enormous amount of debt. And if this rate keeps on rising to the 4% level, then there's probably going to be a lot of companies that are, and individuals that are defaulting on their debt. And the Fed really doesn't want to have a waterfall, a chain of defaults that create another financial crisis. And many of the pundits, people a lot smarter than me, say that 4% is roughly around the level at which that might happen. The other thing to bear in mind, and I think that this might be part of what the bond market has been pricing in, is that quantitative tightening, which has been going on for some time now, is set to double next month. And this doesn't get as much headline attention as interest rates. Interest rates are fairly easy to understand, but QT, which is effectively almost the opposite of QE, it's not really selling off of what was bought, it's just allowing it to mature and roll off of the books. This creates a huge vacuum in terms of liquidity in the markets where these types of assets exist. And so we could see a lot of volatility in these markets, and these markets underpin a lot of other markets throughout the world. Bond markets are the largest market in the world, by the way, much larger than the stock market. And although we've seen a lot of volatility recently, this has the potential to amplify that volatility potentially in coming months. Once again, the pundits say that the Fed will not carry out their entire plan when it comes to QT, but they are most certainly going to ramp up QT next month. Now, the Fed was not the only pony at the Dog and Pony show in Jackson Hole last week. We heard from a number of central banks, one of the largest of those, of course, being the European Central Bank. And now they are turning incredibly hawkish too. So they're a bit of copycats when it comes to Europeans. They like to copy what the US does, but also they're in a situation that is forcing their hand at the moment. The price of energy is going a little bit nuts. I'll talk about that in a minute. Inflation is on the rise, and rising energy costs and costs elsewhere are driving inflation higher. And so the ECB is saying that they now they're using this very strong hawkish statement, sacrifice, in order to tame surging inflation. I'll come back to Europe in a minute, but I did also want to just look at some leading indicators in terms of economic activity in the US. So here we have the mortgage purchase applications index, and so this is showing the mortgage application activity, obviously, you can tell from the name, within the US economy. And you can see that there was a high back in towards the end of 2020, beginning of 2021. And this has been dropping off. There was a bit of a bump towards the beginning of this year, but this has been dropping off largely since then and has lost more than a third of its value. So more than a third of that activity gone. And we are now back at levels not seen since the 2020 collapse. If we look further back, we can see that we are now at levels last seen in April 2015. This tends to be a leading indicator because interest rates most obviously and most directly and most immediately affect mortgage applications. And if you've been following the story in the US, you will know that mortgage applications have dropped because the rates have risen significantly and house prices are starting to fall quite dramatically too. So this leading indicator is saying that the US economic activity has dropped off of a cliff, and it's just not apparent in other parts of the economy just yet. If we look at the US manufacturing business sentiment survey, so there are different versions of this within the US, but you can see that the regional average right now is incredibly low. One of the lowest points that we've seen for many, many years, going all the way back to 2008. And so businesses within the US are saying, we think that we don't have a great business environment at the moment, and that things are going to become quite tough. They are becoming tough. And once this number drops below 50-ish, and you can see that the trend has been downwards, it means that the country is in a recession. All right, so back to Europe. Last week we saw, was it last week? Yeah, last week we saw French electricity exceed 1,000 euros for the first time. So energy prices are going absolutely vertical right now. And this map is showing that wholesale day ahead electric prices breached the 700 euro per megawatt hour barrier in multiple countries. 2 years ago, the typical price was less than 50 euros per megawatt hour. So that means a more than 10 times increase, nearly a 15 times increase on the average just 2 years ago. This is having all sorts of very obvious direct consequences. Some of them are laid out here at the moment. So there are many fertilizer companies that are saying we just cannot afford to run our businesses with electricity being this pricey. So Europe's largest fertilizer company saying that it's cutting some of its fertilizer production by 50%. Britain's largest fertilizer plant saying it would temporarily halt production at one of its plants. And this is a story that we're seeing all around Europe. Now, obviously, with less fertilizer, it means that there will be a lower yield on the crops that won't produce as much. So are we looking at a food shortage and another rise in food prices through the coming year? I guess we're going to find out. And then there are some indirect consequences of these energy price rises. So a byproduct of fertilizer is CO2 gas, and that's used to fizz beer, soft drinks, it's used in hospitals, it's used for animal slaughter. And so this means an outright halt in some cases at companies in these industries, or at least a slowdown, which most certainly will also drive prices higher. Now, I'm talking about just a very specific, narrow set of consequences to this energy crisis. But obviously there are things happening all across the board, and I'm not sure how this energy crisis will be resolved in the short term without some kind of an abrupt end to the Ukraine war, which I don't think is on the cards. So there's a lot of pessimism out there right now. The US Fed and other central banks have put their statements out there contributing to the pessimism, but there are a few silver linings too. One of these I mentioned briefly before is that the US core PCE price index came down, and actually came down by more than was expected. So the previous reading was 0.6%. It was forecast to hit 0.3%, and in fact came in at 0.1%. So this is most certainly trending downwards. It's perhaps a little bit more obvious from this chart that the direction is downwards. And as I mentioned, this is the preferred gauge of inflation by the Fed. So if this continues downwards, together with other measures of inflation also moving downwards, we could see the Fed turn more dovish. The Fed obviously just doesn't want us to think that they're going to turn more dovish in the absence of any real data that lets them do so. Another piece of optimistic news is that it looks as though the US and China are getting closer to a deal that will allow the US to audit the books, or at least part of the books, of Chinese companies that are listed in the US. So we saw a number of US listed Chinese companies rallying quite strongly last week, and I think as this becomes more of a certainty, hopefully it does become a certainty, that those companies would continue to rally because they've been hammered by this single risk item quite strongly over the past year and a half, 2 years. So under this particular agreement, American accounting regulators would be able to travel to Hong Kong to inspect the audit records of Chinese companies listed in New York. I will continue to watch this one closely. I think about a month ago, maybe a month and a half ago, I moved my New York listed Alibaba stocks to Hong Kong listed Alibaba stocks just to avoid this risk. Other news items to be optimistic about? Well, China, like it has been doing just about weekly for the past few months, is adding additional stimulus measures in order to try and turn its economy around. It's now pledged $1 trillion more of stimulus, and there are various ways in which it's going about deploying this. It's creating quotas in various sectors within the economy, and applying discount and funding, saying we need more people to work within this particular sector to help it grow. So they've been cutting rates in several areas for a while. That hasn't worked as well as had been anticipated. People are wary of taking on debt because they're concerned that they're not going to be able to pay back that debt. So now the Chinese government is going into the economy and trying to stir up that demand itself, to try and trigger it and potentially pull in other non-government participants, so that they start lapping up some of that very cheap credit that's available at the moment. The real estate sector within China, a very large part of their economy, has also been a headline item in terms of risk for a while now. And in addition to the loosening of economic policy, the stimulus that they're introducing into the economy, they're also extending special loans, $29 billion worth of special loans to troubled developers to help them weather the storm. All right, so in terms of this week, earnings are we're definitely at the very tail end of earnings for now, and earnings will pick up once again roughly in the middle of October, so a month and a half from now or so. In terms of macro data that's coming out, it's a holiday in the UK today, and there are many bits and pieces of data coming out through the week, but I think that the market will be focusing mostly on the data coming out on Thursday. So PMI data coming out of a number of geographies. Once this number tips below 50, it's increasingly likely that these countries will fall into a recession. We can see that the UK, the expected value is 46 and was 46 before. These tend to be leading indicators, and so they set people's opinion about what will happen in the near-term future. All right, so last week was quite a week. We had central banks saying, listen, you guys have been way too optimistic, way too early. You need to hang in there. Stop buying up equities and creating these crazy rallies when our underlying economic data still isn't that great and when we're still trying to get a handle on this thing called inflation. They laid out very aggressive, hawkish plans to keep inflation in check, and they've said that we don't mind if this affects growth because we need to look at the number one problem, which is inflation. So do not think we're going to pivot early. But we can also see from a number of leading indicators that economies probably are weaker than they seem. It's just that that weakness hasn't filtered all the way through those economies just yet. And so with inflation seeming to be on the decline and economies slowing down, and those two things are tied together, by the way, I think that the Fed probably will not need to be as hawkish as it's saying all the way through next year even, but they have had to fire a shot across the bow just to stop people being a little too optimistic too early on. All right, that's it for this week. Thank you. Goodbye.